Something unusual has been happening in the housing market, and many people are only beginning to notice it. Over the past decade, an increasing share of homes across the United States have been purchased not by families, but by investors. In some recent quarters, investors purchased roughly 27% of homes sold nationwide. That means more than 1 out of every 4 homes went to an investor rather than someone planning to live in the property. At first glance, this might not seem like a dramatic shift. After all, investors have always been part of real estate markets, but the scale and speed of investor activity today is changing the housing landscape in ways that could affect an entire generation of home buyers. For decades, home ownership has been one of the most important ways families built wealth. Buying a home allowed households to build equity over time. As property values increased, that equity often became a financial foundation passed down to the next generation. Homes were not simply places to live, they were long-term financial assets that allowed millions of families to grow wealth over time. But the housing market today looks very different from the one previous generations experienced. Across many parts of the United States, housing prices have increased dramatically over the past 10 years. In some regions, home prices have doubled. Meanwhile, wages have not kept pace with those increases. This means that many young buyers today must dedicate a much larger portion of their income to housing than previous generations did. At the same time, the United States faces a housing shortage estimated at more than 4 million homes. When supply is limited and demand remains strong, prices rise. And when prices rise, investors with large amounts of capital gain an advantage. Many institutional investors can purchase homes with cash, allowing them to move quickly during bidding wars. Individual buyers, by contrast, often rely on mortgage approvals that take time and introduce uncertainty. Sellers frequently choose the fastest and most reliable offer, which often comes from an investor. But the story of investors buying homes is more complex than it first appears. Despite headlines about corporate landlords and Wall Street buying neighborhoods, large institutional investors actually own a relatively small portion of the overall housing market. Nationwide, large institutions own only a small percentage of single-family homes. However, their presence can be highly concentrated in specific markets. In certain metropolitan areas, investor ownership of single-family rental homes can reach double-digit percentages. In those locations, the impact becomes much more visible. Imagine a neighborhood where a large number of homes are purchased by investment firms and converted into rental properties. Over time, fewer homes remain available for individual buyers. More residents become renters rather than homeowners. The entire structure of the neighborhood begins to change. This trend has accelerated during periods of housing market disruption. After the housing crash of 2008, large investors entered the market aggressively, purchasing distressed properties at discounted prices. Those homes were often converted into rental housing. Today, a similar pattern appears in certain markets. Although the circumstances are different, instead of distressed homes, investors are now competing directly with traditional buyers. Why would investors want to own thousands of residential homes? The answer lies in the financial structure of real estate. Housing has historically been one of the most stable assets available to investors. People will always need places to live. That means rental housing can generate consistent income over long periods of time. For large investment funds managing billions of dollars, residential housing can provide predictable cash flow combined with long-term appreciation. In other words, investors can earn money both from rent and from rising property values. But investor activity also interacts with broader demographic changes happening in the economy. Younger generations are forming households later than previous generations. Many people are delaying marriage, delaying home purchases, or choosing to move more frequently for work opportunities. These trends increase demand for rental housing. Investors carefully track these demographic patterns when deciding where to allocate capital. Technology has also changed the way real estate investing works. Large investment firms now use sophisticated data analysis tools to identify neighborhoods with strong rental demand and long-term growth potential. Instead of purchasing properties randomly, they can analyze entire markets using detailed data models. This allows them to buy homes at scale. However, the growth of investor ownership raises an important economic question. What happens to wealth building if fewer people own homes? Historically, housing equity has been one of the largest sources of wealth for middle-class families. When homeowners pay their mortgage each month, a portion of that payment builds ownership in the property. As home values increase, the equity grows. Renters, however, do not accumulate equity from housing payments. Rent payments go directly to the property owner. If home ownership becomes harder to achieve, wealth accumulation may shift as well. Some economists worrying that rising investor ownership could make it more difficult for younger generations to build wealth through housing. Others argue that investor ownership helps expand rental supply and provides housing for people who prefer renting. The truth likely lies somewhere in between. Housing markets are influenced by many factors at once: construction rates, population growth, interest rates, investor activity, local regulations. Each of these forces interacts to shape housing availability and affordability. Another factor influencing housing markets is interest rates. When mortgage rates rise, borrowing becomes more expensive. This often reduces the number of buyers able to qualify for loans. Investors with cash reserves may face fewer barriers in these environments. When mortgage rates fall, more buyers enter the market, which increases competition for homes. These cycles create constantly shifting dynamics between investors and traditional buyers. But when you step back and look at the bigger picture, a deeper economic signal begins to emerge. Housing is no longer just shelter. It has become one of the most important financial assets in the modern economy. That means competition for housing now extends far beyond families looking for a place to live. It includes investors, institutions, global capital, and financial markets, and that competition is shaping the future of housing in ways that may affect generations. The question many people are now asking is simple: will home ownership remain accessible to future generations, or will renting become the dominant form of housing in many cities? Economic signals rarely provide immediate answers. Instead, they reveal patterns over time. The growing presence of investors in housing markets is one of those signals. It reflects changes in capital flows, demographic trends, and the evolving role of housing as an investment asset. Understanding these signals does not mean predicting the future perfectly, but it does help explain why the housing market feels so different today compared to the past. Because beneath the surface, the structure of housing itself is changing, and the decisions being made today by investors, policymakers, and households will shape how housing evolves for decades to come. If you found this analysis interesting, subscribe to Hidden Economic Signals. This channel explores the deeper patterns shaping the modern economy, from housing markets to generational wealth, shifts and the hidden forces influencing financial opportunity. Because sometimes the most important economic changes are not the ones making headlines, they are the ones quietly reshaping the system beneath the surface.